There is a specific kind of silence that accompanies a paradigm shift. It isn't the loud, boisterous noise of a market floor or the frantic shouting of a trading pit. It is the quiet hum of a data center, the imperceptible flicker of an optical fiber, and the soft tap of a finger on a screen. For those of us who have spent decades navigating the traditional world of finance, the world of physical bank branches, paper statements, and personal brokers, the rise of financial technology or fintech can feel like a departure from reality. But I would argue it is quite the opposite. It is an intensification of reality. We are witnessing the plumbing of our civilization being replaced while the water is still running. If you are over 40, you have likely built your life on the bedrock of established institutions. You understand the value of a handshake and the weight of a signed document. However, the architecture of trust is changing. To ignore fintech today is not merely a refusal to adopt a new gadget. It is a refusal to understand how the value you have spent a lifetime accumulating is being measured, stored, and moved. My name is The Horizon. Today, we aren't looking for the next big thing or a quick win. We are here to conduct a sober, intellectual audit of the intersection between finance and technology. We are going to look beneath the surface of the hype and examine the machinery that will define the next 40 years of our economic lives. Welcome to a deep dive into the foundations of fintech. A recent report from Bloomberg has pulled back the curtain on a crisis that should give every mature investor pause. A major tech vendor, one of those invisible companies that provides the critical software for real estate financing, suffered a catastrophic hack. This wasn't just a leak of email addresses or marketing data. This was a deep-tissue strike into the systems that handle valuations, title searches, and the movement of escrow funds. The scale of the breach was so significant that it didn't just trigger an internal IT response. It brought the FBI and the nation's largest banks to the table in a coordinated emergency effort. When the FBI involves itself in a private vendor's breach, we are no longer looking at a corporate incident. We are looking at a threat to national economic infrastructure. According to the Bloomberg analysis, the concern among federal investigators and Wall Street risk officers isn't just the data that was stolen. It's the potential for systemic freezing. If the software that validates who owns what and who owes what is compromised, the entire machinery of the property market grinds to a halt. For the investor over 40, the takeaway is sober. Your equity is only as secure as the weakest link in a vendor's software chain. To understand how we got here, we have to look at the evolution of trust. If you go back 20 or 30 years, real estate was a business of localized institutional trust. It was a world of handshakes, physical ledgers, and local bank branches where the manager knew the property and the borrower. Risk was contained within a geographical and social circle. Today, that world is gone. We have transitioned from handshakes to APIs, application programming interfaces. We have globalized and digitized the tech stack of real estate finance to allow for massive scaling and instantaneous reporting. But our risk models haven't kept pace with this shift. We are still performing due diligence as if we are in 1995, focusing on the cap rate and the physical inspection, while ignoring the fact that the entire investment is now sitting on a digital perimeter that we neither own nor audit. We have outsourced our trust to software-as-a-service platforms, assuming that because they are institutional grade, they are invulnerable. The Bloomberg report proves that institutional is no longer a synonym for impenetrable. This brings us to what I call the dependency trap. Large institutional banks, the names you see on the sides of skyscrapers, don't actually build most of the technology they use. It's more cost-effective for them to outsource specialized tasks like title insurance processing, escrow management, and property valuations to third-party tech vendors. This creates a dangerous paradox for the mature investor. You might do your due diligence on your bank, looking at their balance sheet and their reputation, but you have zero visibility into the security protocols of the niche software firm the bank uses to process your title. These vendors are the new weakest link in your net worth. They are often smaller companies that, while technically proficient in their specific field, lack the multi-billion-dollar security budgets of a JP Morgan or a Bank of America. Yet, because they are integrated into the systems of the giants, they represent a wide-open backdoor. When a vendor like the one mentioned in the Bloomberg report goes down, it doesn't just mean a delay in paperwork. It means the bank can no longer verify the digital integrity of the asset. They cannot confirm clear title. They cannot move funds. In that moment, your tangible home is effectively frozen in digital space. For the man who has spent a lifetime building a portfolio, this is the new frontier of risk management. Realizing that your most offline asset is now entirely dependent on an online chain of custody that you do not control. We often talk about de-risking our portfolios by moving into real estate when the stock market gets choppy. We treat property as this safe haven, because we believe it is disconnected from the madness of the digital world. But the FBI's involvement in this recent hack proves that this disconnection no longer exists. The plumbing has been merged. Whether we like it or not, our homes have been tokenized and indexed into a global financial machine. This isn't a reason to panic, but it is a reason for a deeper, more intellectual honesty about what safety means in 2024. As we move forward in this deep dive, we will analyze why the federal response was so aggressive and what it signals about the future of property rights in a digital age. If the lock on your front door is now digital, it's time we start asking who else has the key. We are moving past the headlines to understand the systemic fragility of the assets we worked a lifetime to acquire. We often think of a cyber attack in terms of data theft, stolen social security numbers, or leaked passwords. But as the Bloomberg report regarding this recent real estate finance breach suggests, the stakes for the mature investor are far more structural. When a critical vendor in the real estate plumbing is compromised, we aren't just looking at a privacy issue, we are witnessing the freezing of liquidity. For those of us over 40, we understand that the value of an asset is inextricably linked to its portability, your ability to sell, to refinance, or to access equity when needed. In the digital age, that portability is entirely dependent on a chain of invisible software vendors. When one link breaks, the entire machine seizes. Large banks aren't just worried about the loss of data. They are worried about the clog in the pipes. If a vendor responsible for title searches or valuation goes dark, the multi-trillion-dollar mortgage market doesn't just slow down, it stops. This is the new fragility of real estate. Your home equity, which you can physically touch, is effectively locked behind a digital door to which you do not hold the key. The involvement of the FBI, as noted by Bloomberg, signals a shift in how the state views our personal assets. This is no longer categorized as a corporate IT incident or a routine patch management failure. When the Bureau and the nation's largest financial institutions sit down at the same table to assess a vendor breach, they are acknowledging that real estate finance has become a matter of national economic infrastructure. Consider the sobriety of that reality. In the past, a threat to your property was physical fire, flood, or a local bank failure. Today, the threat is an abstract vulnerability in a codebase you've never seen, managed by a company you've likely never heard of, yet significant enough to warrant federal intervention. For the intellectually honest investor, this is a signal to stop viewing cyber risk as something that happens to tech companies. It is something that happens to the bedrock of your net worth. The FBI isn't there because a vendor lost some emails. They are there because the integrity of the U.S. housing market, the world's largest asset class, is now a digital frontier that is increasingly difficult to defend. For decades, we have allocated capital into real estate precisely because it was perceived as disconnected. It was the offline hedge against the volatility of the stock market. But this recent hack forces us to reevaluate the safe haven status of property. If your home equity is tethered to the same fragile digital ecosystem as a speculative tech stock, does it still deserve the same low-risk premium in your portfolio? As we age, our tolerance for systemic surprises decreases. We aren't looking for 10x gains. We are looking for the preservation of what we have built. Intellectual honesty requires us to admit that the digital twin of our real estate, the data, the title, the debt records, is currently more vulnerable than the physical structure itself. We must start accounting for digital counterparty risk. When you own a property, you aren't just betting on the neighborhood or the local economy. You are unwittingly betting on the cybersecurity budget of a software vendor in a mid-sized city you've never visited. It is a sobering realization that requires a more nuanced approach to asset allocation and risk management. So how do we respond? We do not panic, but we do audit. Building long-term resilience starts with verifying the digital integrity of your tangible assets. First, consider services that monitor your property title for unauthorized changes. Don't assume the paper deed in your safe is the final word in a digital world. Second, maintain a rigorous analog trail of your mortgage or equity line of credit statements. If a servicer's database is wiped or held for ransom, your personal records are your only leverage. Finally, we must demand greater transparency from the financial institutions we patronize. Ask your bank about their vendor risk management. It sounds pedantic, but it is the language of the modern steward of wealth. The Horizon's perspective is this. The safe haven of real estate hasn't disappeared, but the walls have become transparent. The digital lock on your front door is being picked by actors halfway across the globe. By acknowledging this fragility, we can move from passive owners to informed guardians of our legacy. This is the new reality of wealth. The physical is now digital, and the digital is now systemic. Stay informed, stay analytical, and look toward the horizon.